Welcome back, traders. In this installment of the Market Barometrix Fundamental Analysis Crash Course, we're going to be talking about the financial ratios associated with profitability. We're going to go into detail about the gross profit margin, the operating margin, net income margin, the return on equity, and return on assets. Together, these 5 financial ratios are going to help us answer questions like, how profitable is this company? And how effective is management at converting sales into profits? Understanding how profitable a company is a vital piece of the puzzle as far as evaluating these companies as investment opportunities. And when we measure profitability in relation to industry, sector, and market averages, it provides context. It brings meaning to the metrics that we're tracking. It provides us a way to compare and contrast the performance of our investment candidates next to its direct competitors. So stick around for the rest of the video if you're ready to jump in and learn more about the financial ratios associated with profitability. Profitability refers to a company's ability to generate earnings relative to its expenses, assets, debt, and equity. So the first facet of profitability that we're going to look at is margin. And when we say margin, what we're talking about is what portion of revenue is being converted into profits, right? What portion of our sales is getting turned into profit for the company and for shareholders? 3 of the different financial ratios that we're going to be looking at today have to deal with margin. We have the gross profit margin, the operating income margin, and the net income margin. Now, each of these ratios are going to tell us how profitable is this company at different levels of profit. Together, these 3 financial ratios give us a comprehensive look at how effective management is, how effective this company is at turning sales into profits. And that's what, as investors, we're curious about. The more profitable that a company is, the more effective it is at converting sales into profits, the more value it's going to have for shareholders, and that's going to be a positive for share price. The second facet of profitability that we're going to be measuring is return. Now, this has to do with the company's ability to generate a return on the assets that it owns and the return that it's generating relative to its equity funding. We'll be using the return on equity and return on assets ratios to measure profitability in this way. And again, the better the return that a company can generate from its assets and its equity, the more value the company is going to have for shareholders, and that'll provide a tailwind for share price. So now that we have a better idea of what profitability is, how it's measured, and why it's important to us as investors, let's jump in and talk about the specific financial ratios, how they're calculated, and how we interpret them. First up, let's talk about the gross profit, operating income, and net profit margins. Now, these ratios are actually really easy to understand as long as you have a good understanding of what gross profit is, what operating income is, and what net profit is. And go back to the video earlier in the series on financial statements if you're still a little unclear about these different levels of profitability, but these are all derived from the income statement and basically measure profit at different points along the income statement. And the idea behind each of these ratios is what percentage of sales is each of these levels of profitability, right? So gross profit margin is just what percent of sales is gross profit. Operating income margin, what percent of sales is operating income? And net profit margin, what percent of sales is net profit? So let's jump back over to the income statement and I'll do a quick recap on what each of these levels of profitability represents. So again, the income statement is one of the financial statements and it gives a snapshot of the revenues earned and the expenses involved in generating revenue during a given accounting period. The top line of the income statement is revenue or sales. That's the total dollar amount of sales that a company made during that accounting period. So we see here in the income statement the different levels of profitability. We have gross profit, EBITDA, EBIT, EBT, and net income. The 3 financial ratios of margin are the gross profit margin, calculated from the gross profit level of profitability. We also have the operating income margin, operating income being synonymous with EBIT from the income statement here. So operating income margin is calculated from the EBIT level of profitability. And we also have the net income margin, which is the bottom line of the income statement here, and it represents profit after accounting for all the costs and expenses that go into ongoing business operations. So if we wanted to calculate gross profit margin from our fake income statement here, we would take gross profit of $1,346,000, we'd divide that by revenue of $2,135,000, and we'd multiply by 100. That gives us a gross profit margin of 63.04%. Similarly, if we wanted to calculate operating income margin, we would take the EBIT or operating income here of $785,000, divide that by revenue of $2,135,000 times 100 gives us an operating income margin of 36.77%. Lastly, net income margin would be $649,000 divided by $2,135,000 times 100, giving us a net income margin of 30.4%. So calculating these ratios is fairly easy, but what does it all mean and what does it tell us about this company? How do we use it as investors? Just like many of the other metrics that we look at when conducting our fundamental analysis, profit margins are going to vary widely from industry to industry, sector to sector. So there's not really a universal standard as to what's a good profit margin, what's a good gross profit margin, what's a good operating income margin, what's a good net income margin. So what's important is to put these things into context as far as how does a company stack up relative to its industry, sector, and market competitors. So we're going to compare these numbers to industry, sector, and market averages. What we'll be hoping to find is that a company is more profitable than its competitors. Particularly, we'll be interested in, is this company more profitable than its direct competitors, right? Its industry peers. We'll also want to look for inconsistencies across these three levels of profit margin, right? So let's say, for example, a company is more profitable than its industry competitors as far as gross profit margin is concerned. But whenever it gets down to operating income margin, that same company is less profitable than its industry peers. Well, that would tell us that there's something going on in the indirect costs and or depreciation and amortization of this company that's causing it to be less profitable than its industry peers at that level. So these are the types of insights that we're hoping to gain by looking at several different levels of profit margin. So stick around for later in this video where we're going to jump into the market barometer and do an actual analysis of a company's profit margins. But before we get into our example analysis, let's talk about return on assets and return on equity. Now, return on assets just takes the net income and divides it by the total assets. So again, net income comes from the income statement, and it tells us how profitable a company is after deducting all the costs and expenses associated with ongoing business operations. Return on assets specifically measures how well a company utilizes its assets and determines how profitable a company is in regard to its total assets. Generally, we want to see a higher return on assets, indicating to us that management is doing a good job of generating earnings from the assets that it owns. And again, we'll want to put this number in the context of industry, sector, and market averages so that we can better understand the implications of a company's ROA. Return on equity, or ROE, is similar to return on assets, only this time we're measuring net income relative to shareholder equity. Shareholder equity being that portion of the capital funding of a company that was sourced through the sale of shares of ownership in the company. Now, ROE is going to be highly dependent on a company's capital structure, and in general, return on assets and return on equity can shed light on a company's ability to generate returns from its debt and equity financing. So the greater proportion of a company's capital funding that comes from debt, the higher the return on assets and the return on equity you would expect to see. So while an ROA and an ROE that are above industry, sector, and market averages is generally a good thing, when the ROA or ROE is significantly higher than industry and sector averages, it might indicate that the company is over leveraged, that they're using too great a portion of debt to finance their business operations, and while that's leading to greater profitability, it could also lead to increased risk. So it's all about finding a good balance, optimizing profitability without exposing the company to too much risk. Now that we have a better understanding of the financial ratios associated with profitability, let's continue our analysis of applied materials. So here we are in the Market Barometer. I have us in the fundamental analysis section of the software, and this is the profitability trend tab. This is going to give us access to all the financial ratios associated with profitability. So a quick recap of the software here and what it's telling us and how we use it for those of you that are watching this video out of order. On the left, we have the bank of buttons that's going to allow us to select which financial ratio we want to look at. So clicking any of these buttons is going to update the charts and figures on the right. So this topmost chart in yellow is the specific company we have selected. So we're looking at applied materials right now, which is in the technology sector and the semiconductors industry. The figure to the left of the chart is going to be the year-to-date year-to-date average of the financial ratio that you have selected. So right now we're on the gross profit margin. Applied Materials year-to-date average gross profit margin has been 43.9%. Below that, this light blue chart here is going to be the industry median for the financial ratio you have selected. So Applied Materials is in the semiconductors industry, and this chart is giving us a look at the industry median of the gross profit margin and how that's trended through time. Below that, this chart in red here is going to give us the same thing but for the entire technology sector. And below that, the same thing but for the entire market. So this is how we're going to perform our comparative analysis, right? We're going to put the top chart here, Applied Materials itself, we're going to measure it relative to the industry median, the sector median, and the market median. So at a glance, we see that with a year-to-date average gross profit margin of 43.9%, Applied Materials is on par with the industry median. So its gross profit margin is about the same as its direct competitors in the semiconductors industry. And we see that in general, Applied Materials and the semiconductors industry is slightly less profitable than the technology sector as a whole, but again is pretty much on par with the market as a whole, with a market median of 43.6%. The only thing that's really notable about what we're seeing so far is that Applied Materials has become more profitable as far as gross profit margin is concerned over the last several years, while on average the semiconductors industry has become less profitable over that same time frame. Let's move on to operating income margin to see if there's any more information that we can gather from that level of profitability. Now that's interesting. You know, Applied Materials is quite a bit more profitable than its industry sector and market peers at the operating margin level. And that's the type of inconsistency that we want to look for. While Applied Materials was basically in line with its peers as far as gross profit margin, when we get down to the operating margin level, we see that Applied Materials is substantially more profitable than its peers. So what does that mean and what does that tell us? Well, let's consider the difference between gross margin and operating margin. Again, gross profit margin tells us the percentage of sales that are getting converted into profit after accounting for only the direct cost of producing a company's product or service. Operating profit is the next level of profitability after gross profit. It considers the direct costs of producing the goods and services, but it also considers the indirect costs. Things like wages for employees that weren't directly involved in producing the goods or services, or other things like the rent expense on the building where the products are produced, right? And I suspect that when we check net profit margin, which is the next level of profitability down after operating margin, that we're also going to see that the company is much more profitable. And sure enough, that increased profitability has carried all the way down to the net profit margin. Now those are the types of insights that we're hoping to find and that the Market Barometer helps demonstrate to us. And this is the type of analysis that helps us identify those important questions. The question in this instance being, why is Applied Materials more profitable than the industry averages when it comes to operating and net profit margins? Well, we know that it has something to do with Applied Materials' indirect costs of business operations. And it tells us that Applied Materials has less costs associated with its ongoing business operations outside of the direct cost of producing its goods and services. And thus, Applied Materials does a superior job of converting gross profits into operating and net profits. Let's move on to return on assets and return on equity to see if there's any more information that we can gain from this section of the Market Barometer. So let's first take a look at return on assets. And look at that, Applied Materials has a substantially higher return on assets than its industry sector and market peers. And I'll bet if we look at return on equity, it will be similar. And look at that, Applied Materials with an average year-to-date return on equity of 32.5%. Almost, 5 times the industry average. So what does that tell us exactly? Well, it tells us that Applied Materials is doing a superior job of generating a return on its assets and relative to its equity. But why would that be exactly? And what might cause that? You know, a slightly elevated level as far as ROA and ROE are concerned might just indicate that Applied Materials is slightly more efficient with its assets and its equity. But returns that are this much greater than the industry sector and market averages alludes to some other fundamental structural difference in the way that Applied Materials is set up. Well, if you guys have been watching this video series sequentially, you'll know that we already looked at the solvency of Applied Materials. And when we looked at that, we saw that Applied Materials was utilizing more leverage. It sources a greater proportion of its capital funding from debt than from equity. And we measured that through the debt to equity and debt to assets ratios from the solvency trend tab of the Market Barometer. Now, capital funding sourced from debt is generally more cost effective for a company than capital funding sourced from equity. So Applied Materials' higher relative debt levels is allowing it to produce a higher return relative to its assets and its equity than its industry sector and market peers, but at the cost of increased risk. So what we found is that Applied Materials is generally more profitable than its competitors, and that has to do with its superior ability to convert gross profits into operating and net profits, and then it's able to produce a better return relative to its assets and to its equity due to increased leverage and increased risk. There you go, folks. An in-depth look at the financial ratios associated with profitability and how we can interpret those financial ratios and gain a deeper understanding of company performance. We looked specifically at gross, operating, and net income margins, as well as the return on assets and return on equity in order to paint a comprehensive picture of company profitability. It also clued us into some of the important factors driving company performance. And when we use the information that we gain from assessing a company's profitability in conjunction with the analysis that we're performing as far as the valuation, growth, and solvency of a company, we're able to create a narrative that helps us to understand company performance and those key factors that are driving that performance. So if you haven't done so already, I encourage you guys to check out the rest of the videos in the Fundamental Analysis Crash Course series to learn more about how to put all these things together in order to understand what's driving a company's performance and to help you make better, smarter investment decisions. So if you guys like this video, go ahead and subscribe to the channel, hit that like button, comments down below, and until next time, thanks for tuning in. We'll see you guys in the next video.